Number 10, relying on TA only. TA is great until it doesn't work. That is why it's important to stay up on market dynamics with the S&P 500, NASDAQ, and the Russell 2000. If over 2,500 stocks are dumping while yields are pumping, it's hard to believe that TA will always find the few trades that make sense. Number 9, trading through earnings without a protected trader hedge. Obviously, we all invest money besides trading, but we don't want our trade to make us an investor on a 10% expected move going down instead of up. In general, trading through earnings on a particular stock is a no-no, except when the trade has been protected by selling off at least half the trade on the remaining amount I'm up based on the percentage is more than the expected move. Number 8, trading P&L dollar amount versus percentage. This is especially true when people trade small accounts and they'll tell me something like, I only made $400 this week. And then they say their account is $10,000. Heck, you do that every week in a year and you'll have tripled your account. Number 7, waiting to correct a trade mistake. Ever buy a put instead of a call? Ever buy 1,000 shares instead of 100? Trust me, we've all been there. Go ahead and share in the comments below what your biggest mistake you had to correct quickly. I think that is the key. Correct it quickly. If you try to talk yourself into how maybe a higher power meant for it to happen, hurry and come back to earth and correct it ASAP. Number 6, not protecting trades by locking in profits on the way up. As I have backtested all my take profit and stop loss levels on the hourly uniquely for each equity, as soon as I reach them, I evaluate the trend and in many cases protect the trade by selling half of it and moving the stop loss to a minimum of break even, or if the trend is holding the 5 and 13 EMAs, I will wait to protect the trade, all the while moving my stop loss up until I see the average directional index indicate a breakdown, and then we'll start to lock in profits, which at this point is above the optimal take profit, and more aggressively move my stops higher, which of course has all been back tested to maximize profits. Typically I sell another 25% when maybe I'm going into key resistance level, or after moving higher and the trade using TA is showing that the trend is breaking down, or a reversal of the trend by the 13 crossing below the 5 EMA when the MACD and stochastic indicates the trade's momentum is exhausted. Before moving on to the final 5, let's face it, we've all been guilty of these at one point or another, but if you subscribe, I'll make sure we review trades and the market dynamics on this channel. Hopefully, it only improves your success. Moving on to number 5. Number 5, cutting winners too early. The last 25% remaining on the trade sometimes can be pay dirt. Selling this too early can sometimes be the difference between making money and making big money. If I see a break of the 5 EMA, I won't cut it until I see a sustained break of the 13 EMA. Typically, a wick below the 13 EMA and reversing is bounce territory. Number 4, FOMO into trades when the train has already left the station or they've topped. Trading involves emotion and everyone loves a winner, but jumping into a trade after it's already reached its take profit is dangerous. Trust me when I say there's always another trade out there, and don't chase a trade, but instead focus on the next opportunity. Number 3, averaging down on a losing trade. Losing trades happen, so there's no reason to YOLO on the way down when encountering a stinker. Stick to your trade plan and buy into breakout momentum. Number 2, risking more than 1% of your account on any one trade. I guess since we're on the topic of YOLO, risking more than 1% of your account is just nonsense. This doesn't mean the trade is only going to trade 1% of your account, but instead it means that you calculate your max loss. It needs to be less than 1% of your account. For example, if you had a $10,000 account and you had a trade with $3,000 in it and a 3% stop loss, then the max your account could lose would be $90, which means you're under 1% risk. Now this is a max, so it's like the speed limit. Feel free to go much below this as you want. Sometimes managing more than a handful of swing trades can be tricky if you're new to it, so figure out what the right number is for you. And now on to number 1. Drum roll please. Number 1, trading without a stop loss. You better know the color of your parachute on this one. From the time you enter a trade, the single most important thing is knowing at what point you fold them. Losing trades do happen, and rule number 1 is limit losses. And rule number 2 is follow rule number 1. And rule number 3 is follow rule number 2. Do this and you'll always be ready to enter the next trade. If you want to see some of what I discussed here in action, then just click this video and I'll take you through a Tesla buy signal and how I evaluate its entry and more information on the entire trading system with more details. And of course, if you want to get notified in real time, then join the paid Discord for $5 per month. As that's all I have for now until our next video, and I'll see you then.